Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question.
I noticed that my policy loan rate changed this year. Why? Okay, so as interest rates rise, your variable rate loan is also going to rise. So the rate increases are part of your policy contract. So most insurance companies have a cap on how high the rate can rise. Check your policy contract for more details. It'll be in there. They'll have like specified maximums in there. The other issue is like, so now, and I don't know what carrier you have, but now at least, maybe this question was being asked. Some of these have come in and I've not gotten to all of them. So this might've been something that was asked a little while back, but a lot of actually loan rates as of, this is in April of 2026. A lot of rates have flattened out, and some of them started to either flatten out or go down, and maybe some carriers are still raising them a little bit, but I don't think we're going through any major increases, at least not anytime soon. We might continue to see this, but anyway, you could see what the maximum are in your policy contract, and you'd have to dig out your contract to find that. But as a practical matter, I really wouldn't worry about it too much. So in general, as interest rates rise, so do dividend rates, right? That's kind of the nice, it's sort of like your loan rates and your dividend rates on your participating whole life policy are, I don't want to say mirror image, but they're tied in a certain way. They're not directly tied, but there's an implication of one going up. Typically what's going to happen is your dividend rates also going up, not because loan rates go up. So it's not like because dividend rates go up, because loan rates go up, dividend rates go up. It's just that as interest rates in the market rise, so carriers are using excess interest from bonds and some other investments and so forth, you just tend to see the dividend rates go up. And then the loan rates are also going up. They tend to move kind of, not exactly one-to-one, but I'm saying just in general, the trend seems to go in the kind of the same direction for both. There are times where you could see move in opposite directions, but it's usually you're going to see them trend together, even if they don't move in lockstep. Anyway, I wouldn't worry about it. Dividend rates will lag new money rates, like loan rates, but eventually they're going to rise together and be relatively close. Long term, I would say the net cost of policy loans should remain very low. So it's on whole life insurance, even on ULs, a lot of ULs build it in, so it's intentionally going to be either a wash loan or a very low cost loan. That covers the loan issue. Next question is, how much money should I save through life insurance? Oh gosh. Most life insurance companies are going to cap your premiums at some percentage of your income, or they're going to have some kind of limit based on your income. I know one carrier caps it at 25% of your income. They just, hey, if you're getting more, you have to get individual consideration if you're going to be paying higher premiums than that. Some people think that this is a lot, I guess, which it is for some, not for others. Either way, that's where it becomes much more difficult to convince an insurance company to sell you more insurance. So they're gonna say like, hey, if you make $100,000 a year and you're paying $50,000 in premiums, an underwriter is gonna look at that and say, like, how are you gonna afford this, right? So I have occasionally heard stories of people somehow getting through this and somehow they were sold a policy and they got a policy and it was like the premiums were 40% or give or take of their total income. I'm not sure how that makes it through underwriting. I've never had that happen before. Underwriters will always, not that I've tried necessarily, but I've gotten cases gotten close, and underwriters will ask if the premiums are getting up there and they're getting pretty close. They start asking like, hey, they want to know financials. Can this guy afford it, kind of thing. So maybe that happens with some carriers and some carriers where they have looser underwriting or something. I won't name names, but I could see it happening at a couple of carriers. I could see something like that maybe somehow slipping through the cracks. But carriers, that's not to say, like, even the top tier carriers, they will make exceptions, for estate planning purposes, or if you're funding a policy with a large lump sum, you have like money in a savings account, for example. You're dumping it into a whole life policy. They'll say, well, okay, so these premiums are going to be obviously higher, but these are not ongoing premiums. This is a lump sum being moved over. But in general, there's going to be a cap, a soft cap, and in some cases a hard cap on the premiums. Let's see. How do policy loans work exactly? Okay, so for a while there was this persistent myth that you're borrowing your own money when you take a policy loan. It's your money. You're borrowing your own money. And even like a lot of the critics would even say this. Why would you put money in a whole life policy? You're borrowing your own money back. So there's a very, and I don't know if you want to, maybe some of this is getting too technical for some people. When you borrow against a life insurance policy, first of all, let's back up a second. When you pay premiums on a policy, you are buying something. You're not just, it's not a savings account. Like, I hate this idea, like, life insurance is just, it's like a savings account. It's like a bank. It's your own, you're becoming your own bank, No, you're not, you're buying a policy, right? Now that's not to say that there's not advantages to doing this. So when you buy a policy, your cash value of that policy it becomes a capital reserve. It's literally a capital reserve set aside to pay for the future death benefit. It's money that is building. I think if people actually kind of had a better understanding of like what is a life insurance, then they would appreciate, they would find it fascinating in its own right. Like, you don't have to turn it into like, this is your own private bank kind of thing. I get that why people do that, because maybe it's easier, like it's something people can relate to. It's something easy to understand. It's a heuristic kind of deal. But I think if you understood, like, this is capital. This is capital that you are setting aside for a future benefit payment. And the insurance company is giving you this large capital sum, and you're not having to pay, you're paying the premium is just going to be a fraction of this dollar amount. So the cash value is growing every single year. And oh, by the way, you get to borrow against the value of that capital. In other words, you are getting a line of credit against that capital. And they even even when you look at how the policy loans are structured, they're structured as lines of credit. You are literally building your own credit line. You're and you're the policy owner. So you're building and owning your own personal credit. And it's fascinating. It's like you have this credit line. You're building up the credit line. You own it because you're the policy owner, and you own this thing, and you have contractual rights to this thing as part of the contract. So when you borrow against a policy, your life insurance company doesn't actually excuse me. Your life insurance company does not actually remove money from your policy. Instead, what they do is they create a loan reserve. And a loan reserve is a fancy way of saying that the company secures your policy loan with money from your policy. The actual loan comes from the insurance company's general investment account. So mechanically, the way that it works is that you receive a loan from the insurance company. Then the insurer uses an amount in your policy equal to the loan as security for the loan. So that was kind of a word salad, probably. So let me give you an example. Let's say you want to borrow $10,000, okay, as a policy loan, okay. So the company is going to send you $10,000 from their general investment account. Then the insurance company is going to secure $10,000 of your life insurance policy's cash value for the loan. So they're giving you the loan. Then you have the policy with them. So they're going to secure part of your policy for the loan. So if you default on the loan, they got the money, right? The reason that they do that is because what they can do, as long as you're not surrendering part of your policy or withdrawing money from your policy, they can keep paying interest on that money. They have a contractual obligation to do that. So they're giving you the benefit of, hey, we're going to keep paying interest on this money. You're not going to surrender part of this thing. Leave the money with us. We're going to lend you some money. We'll keep paying this interest on your money, on your cash value. We'll keep paying the interest here. And then your policy values continue to grow on schedule. You just owe us for the loan. The principal balance, you don't have to pay it back. It's open until your death. If you die with any outstanding policy debt, we just subtract that from the death benefit. So they give you a loan from their general account and then secure an equal amount from your policy's cash value. And then after that, what they do is they charge interest on the outstanding principal amount. Loan interest is charged and it accrues daily. And then at the end of the year, the company sends you a bill for the interest. Now, some companies will say they bill in advance. And I know of one company that does that, where they just assume that you're going to take the loan out for the year. If you happen to pay it off before the end of the year, then they credit some interest back or credit some cash value back. But basically, the way most companies do it is they just interest accrues daily and then billed annually. And at the end of the year, the company sends you a bill. That's what they mean, bill annually. And then you have a choice. You can pay the interest out of pocket. Or if you don't pay out of pocket, then the company adds the interest to the existing loan amount and then starts charging interest on the now larger policy loan amount. The way that most of my clients do this is they take a loan, they set up repayment plan. We figure in what the principal and interest payment should be we just pretend that it's a fully amortized loan, and we pay principal what would amount to principal and interest. And then we make that payment. They just make monthly payments back to their policy. At the end of the year, the insurance company sends them a bill for the interest. And a lot of times we just let the interest capitalize on the loan and build the loan balance up again, because they've been paying it down. They've actually been paying down principal throughout the whole year. We figured out we calculate in advance. We calculate a fully amortized principal and interest payment, and then we pay that payment. But what's actually happening in practice is the principal is being paid down during the year. At the end of the year, interest is charged. So every month they make that payment, the principal is going down, and the amount of interest being charged on the remaining principal as a result is coming down because there's less principal outstanding. So the amount of interest keeps dropping through the year. And at the end of the year, they bill the interest. We say, just let it accrue. And the next year we'll do the same thing. So what happens is you're paying down the principal amount faster and faster and faster. And the loan interest, it doesn't really matter because that's getting paid off. That's getting paid off during the, even though you're adding to the loan balance, the net effect is that the loan is getting paid down really fast. Even if you're not paying the loan interest out of pocket, it doesn't matter because the amount of the payments that you're making during the year offsets that, more than offsets that. So anyway, you make the loan payments during the year, pay down the principal, and effectively pay less total interest on the loan for the year than you would if you just let it accrue on the full loan amount. And that's about it. That's it. That's how they work. So you don't have to pay them off during your life if you don't want to. If you don't pay it off, again, when you die, they just subtract out the outstanding balance, loan balance. They subtract that from your death benefit and then pay the rest to your beneficiaries. So if you have $1 million and you borrowed $500,000, your beneficiaries are going to get $500,000, right? So that's how they. So they know that's why they have such really good favorable terms, because they know, like, one way or another they're getting their money. And so they don't mind, and the policy owner's making out really good too. It's not like the insurance company is winning and somehow the policyholder is losing out somehow. It's everybody's winning. Like the policyholders really like that deal, and the insurance companies like that deal. So everybody wins. As a policyholder, you are getting a very low net cost loan. And in some cases, the dividends on a whole life policy are fully offsetting the amount of interest that you pay on that loan. I've had situations where the dividends paid on my policy were enough to fully cover the loan interest for the year. And so they don't say it's a wash because maybe there's some legal reason why they can't say that, but if you pay $1,000 a year in interest, and then at the end of the year, the insurance company say, hey, your dividends, here's your dividend payment, it's $1,000. Well, then you just fully offsetted the loan interest. And I've had that happen where it's that, and that's not an infrequent occurrence. And now that doesn't mean it's going to happen all the time, and it doesn't mean that it happens in everybody's policy, but I've seen it before, and I know that it happens on a fair number of policies where people have it. Now, there's situations where that won't happen. On a whole life policy, there are situations where that will not happen. On a UL policy, a lot of times the UL policies, they set them up in a way where they will actually advertise what are called wash loans, where the interest is completely offset by interest credits. The problem with the ULs is that everything is assumption driven. So they look at we don't guarantee this will happen. Sometimes they will have a provisions where they say, yeah, we'll do a guaranteed wash loan or something. But and most of the provisions on a UL, and by design, ULs are assumption driven products. So the interest credits are not going to be guaranteed. And when they do wash loans, they usually switch it so that it's like they're taking a fixed interest. They'll switch it to a different bucket, so you're actually earning less money. And they'll say, here's your fixed bucket, and we're paying you a fixed interest rate, and then we're going to charge you this interest rate, and it's going to wash out, right? But they're designed for that kind of thing. And the thing is with the UL is that they don't guarantee interest credits. So on a wash loan, they're changing the rules a little bit, but the normal interest credits that you get, if you were to take a provision that's not a wash loan and hope that you can get arbitrage, and this is the other thing, some carriers will advertise, hey, you might be able to get arbitrage if you just leave it in this other loan option, and you earn this interest rate, you earn these non-guaranteed credits, and the interest rate is this, and hopefully you can get a spread against the insurance company. And that, of course, a lot of people, it's like, oh man, that looks very attractive. Agents like to pitch that because it sounds good in a sales pitch. And of course, policyholders, their greed glands are salivating over this. I could borrow money at 5%. I could make 7%. And that's arbitrage, and they makes them feel like they're doing something really clever and really smart. Most of the time, it's not going to work out that way. It's just on paper it does, but in real life, I won't get into. There's a lot of reasons why that doesn't work out in real life. But the long and short of it is, policy loans are, for the most part, are going to be some of the lowest cost loans that you're ever going to get. So if you want to borrow money, and I get that not everybody wants to borrow money. Some people, they're neurotically afraid, or just, I don't know, they just don't like debt. For one reason or another, they just don't like going into debt. And, I get it, whatever. But if you do need money and you need to borrow money, or you want the ability to borrow money, that life insurance is one of the lowest cost ways to borrow, and it really does favor the policyholder. So anyway, I hope that answered the question. Thank you for sending these in again, and keep sending them in, and I will keep answering them, and I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.